Here we are, sitting in the gutter, just the right place to talk about tax reform, real tax reform, not the bodgy tax reform we've just seen where the Commonwealth Government has passed this so-called tax reform legislation which will decrease the amount of money which is available to provide for public services, public education, public infrastructure, public health and social security benefits, including Medicare. So tax reform, what is tax reform all about? I think before we talk about tax reform, we need to talk about the current taxation system. The two main pillars of the current taxation system outside alcohol and cigarette and petrol excise are company tax, which is responsible for about 22% of tax receipts, and pay as you earn income tax, which is responsible for about 65-67% of income tax. When you give people, individuals, tax cuts, and especially if you give wage earners who earn up to $200,000 the same tax rate as people earning $40,000, you have a problem. You have a major problem in terms of the amount of revenue you can collect. As we discussed last week, the selling off of profitable public assets meant that income no longer comes into the Treasury. And when you've got a taxation system which allows people to legally minimise their tax to almost nothing, to the point where corporations as big as Microsoft and Google are paying less tax than somebody earning $250,000 in this country, you know there's a taxation problem. Now everybody, is concerned about tax, and I am concerned about tax because if you don't actually have tax revenue, and you have what I call inverted tax, where the poor pay more and the rich pay less, there will be less money that goes to the Treasury to provide for essential services which are provided by the state. And that means a decrease in the amount of services, as we see in the social security sector, a decrease in the income that people receive, who find it difficult because of old age, because of ill health, because of parental responsibilities to work full time. And obviously we don't want to get to the good old days when if you didn't earn anything, you basically died on the footpath. That's why I'm sitting here, and that's the analogy. Well, you may want to, but it's not a pleasant way to live. You could walk out of your nice apartment complex and you find that there's all these half-starving people around the place. You do need to employ more security guards to keep them at bay. So I'm actually thinking, when I talk about tax reform, and I'm just thinking of people on social security benefits, I'm thinking of the whole population as a whole, where we live a pleasant lifestyle and a cohesive lifestyle. So if you're really interested in tax reform, I suggest you join public interest before corporate interest. You can download the application form from pipsy.net, or you can write for one at Post Office Box 20, Parkville 3052. Now that I've finished the paid political advertisement, which costs nothing, I want to talk about real tax reform. So how do we increase the tax take so we have enough resources to cover the basic necessities of life for everybody in this country? The first tax I would look at introducing is a 1% turnover tax for businesses and enterprises and corporations which have a turnover of more than $2 million per year. And the reason we've picked a $2 million per year turnover is a very good reason. Because although the corporate sector pays 22% of the taxable income currently, they don't employ as many people as the small and medium-sized business sector. And in an age of deregulation, there are more and more people who are sole traders and individual contractors. And it's almost impossible if you're a small business to compete against large corporations who've got massive buying power. So if we exclude businesses that have a turnover of less than $2 million per year from a 1% turnover tax, that gives them a competitive advantage in the marketplace, which means they'll be able to employ more people. So a 1% turnover tax means that for every dollar that goes through your bank, your till, or whatever, 1% automatically goes to the Treasury. So these large corporations like Amazon, Google, Facebook, which are able to legally minimise their tax via the tax structures and company structures they now have, wouldn't be able to evade that tax. It's a 1% tax on turnover. $1 turnover, 1 cent goes to the Treasury. Doesn't seem much, but over a year it could be up to $100 billion. And when you think the Australian budget is around $500 billion, a 20% increase in the Australian budget, you can do a lot of things with a 20% increase. The next tax we should look at is a stock market turnover tax. Now, Australia is the only country I know in the world where you actually get tax credits and you get money for owning shares, stocks and shares. Could you imagine that? Doesn't matter how rich you are, if you own stocks and shares through franking credits, you get money. And in the next 3 to 4 years, we'll be paying up to $50 billion per year in franking credits to people who own shares. So what I'm suggesting is a 1% stock market turnover tax. No minimum threshold. Now the stock market these days are totally computerised. At the end of the day, if 64 billion has been sold, 1%, which is 640 million, goes into the Treasury. And by introducing this tax on stock market buying and selling stocks and shares, you can raise about $40 to $50 billion per year to go into the Treasury. So our tax intake has already increased by about 35% by introduction of a 1% turnover tax for businesses, enterprises and corporations with a turnover of less than $2 million per year. And we've also increased that take by another $50 billion approximately by introducing a 1% turnover tax. The third area we can look at is mineral exports. Now we have some exceptionally profitable corporations, some owned by individuals, some owned by shareholders in this country, which basically dig up the earth and export minerals like uranium, iron ore, coal, diamonds, gold, and the list goes on and on. We're a very resource-rich country. Now, it's all very well these profits going back to Australian-owned companies and their shareholders, and resources going and profits going back to overseas headquarters. But the important thing is how much of that money actually comes back into Treasury. And that money comes back into Treasury mainly due to taxation on profits of corporations who are legally able to minimise the amount of tax they pay. So I'm suggesting we introduce a 10% tax, not for minerals and resources that are used in this country, but for anything that is exported. So if it's exported, we'll export $1 billion worth of coal. So 10% is $100 billion, $100 million going back into the Treasury. This would raise at least another $100 billion per year. So we've already increased our tax take now by about 60%. So again, local industries would be protected because they wouldn't have to pay the increase, the 10% tax, when they use coal, iron ore, whatever they use here in Australia. But if it's exported, a 10% surcharge. A fourth way of actually raising taxation is what we discussed last week, is the establishment of profitable businesses and services owned by the Commonwealth Government who provide a dividend at the end of the year which goes back into the Treasury. Not only do you provide essential services and look after people's interests, you also have money coming into the Treasury. So that's 3 taxes. Now the fifth thing I'd like to look at is the goods and services tax. when the goods and services tax was introduced in 2000 by the Howard government, it was said that it was going to resolve all the issues about there being enough money to provide essential services because all the revenue would go to the states. Well, unfortunately, the goods and services tax is what is called a reverse tax, where the poor and those who have less income pay more of their income as a percentage of income because of the goods and services tax. So if you're rich, the amount of money you pay in goods and services tax, a lot of this can actually be recouped if you own a business or an enterprise or a corporation. Because what happens is, for every dollar you spend, you get a tax credit, you get a GST credit. What that means is you can claim that credit off your tax bill at the end of the year. So what I'm suggesting again to help small business, which employs a huge amount of people, there are over 5 million small businesses in this country, 80% fail within 5 years of being established because it's very difficult to compete in a marketplace which is dominated by corporations. That the GST credits which businesses and enterprises receive should be removed for any business or enterprise or corporation which has a turnover of more than $2 million per year. So what that means is that again you could raise billions of dollars every year by ensuring that large corporations and businesses and enterprises are not able to deduct the GST credits they receive for the GST they've paid from their final taxation bill at the end of the year. So, these are simple ideas. It's not a matter of revolution. It's not a matter of blood in the gutters of the street. It's not a matter of even violent demonstrations or even peaceful demonstrations. It's a matter of political will. It's a matter of people demanding the state takes an active interest in looking after the affairs and lives of its citizens and its permanent residents. So once again, the 5 things we should look at which could actually increase the tax take from about 500 billion to up to 800, possibly 900 billion, which would be more than enough to cover all the issues which you now face, is a 1% turnover tax for companies with a turnover of more than $2 million per year, a 1% stock market tax, a 10% tax on mineral exports, not tax any minerals which are used locally within the Australian jurisdiction. Last but not least is the removal of GST credits for enterprises and business and corporations which claim these GST credits as a tax deduction at the end of the financial year. We could raise at least $300 billion, maybe $400 billion extra in taxation revenue while having a minimal impact on the Australian economy and ensuring that as a nation we are able to meet the responsibilities we owe to each and every one of our citizens, not just those that own the means of production, distribution, exchange and communication, but each and every one of us. And when 50% of the population only owns 1% of the wealth in this country, you know that we have a major issue as far as not income, generating income, making businesses, but in terms of redistributing profits and wealth in this country.